back to the Capital Mindset Show. Today, we're going to be revisiting a company, and that is Tattooed Chef. So the last time we ever spoke about Tattooed Chef on the channel was last year. So just kind of revisiting because they just had earnings, and we're kind of going to go over the past points as to what we were discussing in the last videos, and some of the concerns we had and had they manifested, and kind of go around that. And then so after that, we're going to get into the valuation, or more like what's going on right now plus valuation, and we explore that a little bit. And then at the very end of this video, we're going to explore a little bit of the ideas of how the macro environment is affecting something like this and how it might affect his performance going forward. Okay, so on that note, let's actually get right down to it. So the first thing I'll actually talk about or showcase to you guys is the actual previous videos that should actually, let's actually find, let me see where they are. So if I go to my channel, we can see, let me pull them up right here. All right, so I'll share my screen here, and then we'll play it together, okay? And then we'll listen to it, and then come across afterwards and kind of discuss what I said.
So when that happens, you're typically going to be having international shipping. And I'll kind of put this up here now, but these are three strategies that I'm really that I would envision and I would want to see Tattooed Chef doing to mitigate these costs, because mitigating their top line costs on their cost of goods sold line is crucial to their business, because it's crucial for pricing. And Fabio, would this be a correct assumption to say that pricing is incredibly important in a sort of business such as Tattooed Chef?
Oh, entirely, because the profits are determined by what pricing they can get on that distribution channel, because that goes into the cost of the business and then will translate to how much money they end up keeping on the bottom line. So yeah, they need to stabilize those costs. If they don't, then they're going to be leaving themselves wide open to inflation. So anyone out there who believes inflation is coming, and this episode's not about inflation, but if you're one who believes that, then you're opening yourself up to a lot of inflation risk here. If you're buying up a Tattooed Chef stock. So you need to be aware of that and say, okay, what is the company doing to mitigate this? And do you believe they're going to be successful at that? So that's something you have to think about and then account for in your pricing.
Mm-hmm. So now to kind of move on from there, Fabio, I've also heard some other people say,
all right, so as you can see in that video, what we basically were discussing was a little bit about the risk regarding the gross margins, and should the business actually come through inflation troubles, that would be very concerning. And then again, that was back in, we could see October 9th, 2021. Okay, and then we made subsequent videos after that, but that was the primary understanding. And actually, if we take a look at, for example, the price action, because I think it's important to kind of indicate what kind of happened throughout that time period. And around since October, it went down as low as 42%. And then now it's only down 31%. So still not doing too good. But, you know, again, that was part of, again, a canary in the coal mine. It's probably I mean, with a whole liquidity crunch we were talking about back then. And the problem with that, right, or the problem with companies like this is, I think there's a lot of retail support, okay, for this company. It's actually a very popular company with regards to you know, retail money, YouTube. I would consider this a YouTube stock. I think I heard that this is a YouTube stock, and I think that's very accurate to actually call it that. You go on, for example, comment sections on Seeking Alpha, you see a lot of people on there from YouTube actually, and people referring to certain creators on YouTube. So I think it's easy to say this is a YouTube stock. Now, with regards to the thesis behind Tattooed Chef, I kind of get it, and you guys can comment down below if you guys are bulls, because, you know, these videos are meant to be open and welcoming. We take it seriously when we're evaluating Tattooed Chef. I'm not here to smack down on a stock. I'm here to take the investment seriously and kind of give you my thoughts. Okay, so Tattooed Chef, the value proposition is to provide somewhat healthy meals to a audience or a consumer that is more and more growing in quote unquote awareness for their health. And so Tattooed Chef is trying to attack that and try to provide, again, healthy snacks, healthy frozen foods, etc. We'll discuss a little bit more in the macro about the customer and some exercises or some mental exercises we can do regarding that. But again, looking so far, hasn't performed very well. And we look at the past 5 years, again, hasn't performed very well at all, only up to about 24%. Of course, this is the pre-SPAC. So this is the SPAC era. And then they went, I think they IPO'd around this time period. And then they went again through a downtrend. So the trend is negative, and the trend is negative on both a 5-year or 1-year basis as well. And, you know, with that being said, we got to look towards the future, not so much harping on the past, right? But it is interesting to note that that is the price action. Okay. So we're echoing back to the video I just showed you guys. I talked about the gross margins and the gross margins being of a great concern, but this is when the gross margins were higher. So I see a lot of people talking about the gross margins being about 2.1%, and I'll actually showcase to you guys right here. So let me see if it's right here. Okay, so gross profit declined to 1.1 million or 2.1%. And then I think they show us their guidance down here, but gross margin guidance is 10 to 12%. Okay, so basically what I gathered from that gross margin being 2.1% is it's a blip. Let's actually take management at its word for it. I'm going to be fair to Tattooed Chef. I'm going to say, okay, they're going to get through it. And basically a lot of the reasons as to why had to do with inflation, which is precisely one of the things we were discussing in the video that the clip that you guys just saw of that video. And how they weren't really able to navigate inflation perfectly. And so they kind of suffered for it on a operational standpoint, right? And had to do with freight, precisely actually what was kind of we were talking about there. So they announced that they were going to make some investments in that area so that they could draw down costs later in the future, right? And they were also going to invest in automation and all that stuff. So those are some of the things that, for example, Tattooed Chef Bulls are going to point to and say, well, look, they're investing in automation that's going to improve and drive gross margins further. We'll actually look at the comparison between Tattooed Chef, and I'll just let you guys know the comparison I'm going to be drawing upon is mainly Conagra. You can compare somewhat to Tyson Foods, but I'm going to compare it to Conagra, and I'm telling you, I'm doing you a favor by doing that, okay? Because Conagra's margins are actually better. Now, let's take a look at Conagra if we take a look at some price action, and then we're going to get into a little bit more details as to the margins, right? But Conagra over the past 5 years has severely underperformed the market. And what I want to say, and I'll focus more on this when we get to the macro side, is that this business is a very difficult business. It's very competitive, and it's also quite cyclical. So you have periods of underperformance. So for example, from here to here, severely underperforming the market, and then spurts of performance that is decent. Okay. So this is a decent level of performance, but not crazy. And then again, we have stagnation. But all in all, this is not the best performer. You do have this beginning outperformance or good performance here. Almost all of their gains happen in this time frame. And someone might say, well, that's what Tattooed Chef is going through. Well, okay, we'll observe and see what are the probabilities of that occurring. Now, this is a large company. It's about 15.3 billion. It's large in this space, at least. And they're very similar to what I see that Tattooed Chef wants to be. Okay, so they want to be this place where they service snacks, they service groceries, they service frozen food items. So that's kind of what they want to be, and I'm going to use them as the comparison. So let's actually go here and take a look at the I made this off the cuff, by the way. So some of these things are actually not really working too well, but literally just made this just before making this video. But we're going to mainly use the model, the valuation model, because a lot of the stuff will be smoothed out. And there's actually a new tool I have in there that I want to use specifically for Tattooed Chef. So again, I looked at Conagra over here, and I'll draw your eyes over to here. And let me zoom in for those of you who are looking through the phone. So Conagra has gross margins of about 26.39%. This is important because we're going to come back to it later, and we're going to talk about the margins. Conagra also has had, and I didn't actually put this down here, but I know off the top of my head, a high-end margin, a high-end cash flow margin of about 13% over the last 5 years. And when I say high-end, it's like that's what they achieved on a high point, right? It's around there. And so 13% for this industry is pretty good, is what I'll tell you. Tyson Foods has a little bit lower margins, but that's fine. They're based on the products that they mainly focus on. Frozen foods isn't the biggest portion. It's actually a very small portion of their business, which kind of makes sense. Now, the snacks segment is going to be higher margin. So the snacks segment right now, Tattooed Chef has an unknown future with it, right? It could succeed, it could not succeed. So right off the bat, if, for example, I'm focused on the snacks section, I can't really think about this as a core holding if that's a main part of my thesis, because that's just potential. It might not be that they execute. When I start to see evidence that they are executing, then I can reconsider my position. But that's if I was even considering it in the first place. Okay, so taking a look at some of these preliminary ideas right here, we can kind of see, I'll show you right here what the level of growth rate that they'd have to do. In order to get to Conagra's size in terms of frozen foods, they'd have to grow at about 42% compounded annually every year from here on out till then, in order to match the frozen foods category. Okay, the white label category, Conagra doesn't really have something in comparison to that. But again, that's going to be slowly over time be less and less part of Tattooed Chef. I think all the bulls have said that already. And then the white label business is about 40% right now of the overall sales picture. And then frozen foods has now surpassed it and now is 61.85%. So frozen foods is a higher margin than white label. White label simply means, when you go to the grocery store, like let's say Trader Joe's, and you see, a bag of vegetables, that's actually Tattooed Chef, what they can supply. The margins there, not very good. Frozen food, think of the branding and all that, they can make that markup, and then that inherently has higher margins. Okay, so these gross margins being very low is quite concerning. However, the full annualized margin rate is about 10.36%, and they're guiding for about 12%, right? So 11, 12, 10%, around there. And then, so I made some assumptions here, but I want you guys to focus simply on the gross profit margins, ignore the cash flow margin and everything down below. That stuff's not really working right now. I might retrofit this like makeshift model for things in the future. It's not really a model, I wouldn't say that. It's more like a visualization of sorts that I might just throw some things in here and there. But really, it's off the cuff. Really, don't ignore most of the things again below the gross profit margin measure. Okay, so gross profit margin is right now sitting at 10.36%. So if we were to assume it were to grow to 26%, that would imply a cash flow margin, or not cash flow margin. Sorry, my bad. The cost of goods sold growth of about 27.53%. That's what it would imply. Okay. And so if we imply a sales growth of 30% and a cost of goods sold of 27.53%, that would yield that result. Okay. And then we would end up getting at around the gross profit margins of that. Okay. So that's the picture. Why did I choose 26%? Because I'm assuming in 10 years' time, they can get to Conagra's levels of efficiency. Of course, that is a compliment to them. That's not a detriment. Okay, so we are being optimistic in that sense. And now looking at the market caps, I want to actually highlight this to you to explain or express the size differences. I've seen some analysis, and I did so on purpose to try to see what other people are saying about Tattooed Chef. And I did see some people have evaluation methods saying that it will be about $1 billion. Now we'll get to the model and we'll see what the model's telling me. But I say right off the bat, that's a very interesting evaluation. Okay, that it would be a fair value at $1 billion because it implies right now is a fair value. It may be under some circumstances that it is, but I don't know under what circumstance. Okay, and again, that's coming off of a point of questioning, right? I don't know the answer. Of course, I've done a video already on Tattooed Chef in the past, and the results weren't very promising at that time. We will see if anything's kind of changed right now. So will they grow to the size of Conagra? Well, if they do, and right now, if you were to buy and they weren't to issue any shares, keyword, you would have 15 extra money by the time they get there. Okay, but let's get to the model and kind of figure out what that really entails. Okay, because there's difference of saying this is a possibility and it actually being a reality. So as the model kind of loads in all the data, I want to have a little bit of a discussion about the share dilution, right? So if a business is overvalued, and this is a question that this is the first mental exercise in this video. I want you to think to yourself as we go through this, is the stock overvalued? And be very sincere about that, because if you're not sincere, that's only going to hurt yourself and no one else. So the sincerity comes from this standpoint. If you are management and you want to raise capital, you must raise the capital at the lowest cost. Well, that includes either bonds or issuing shares. So if I am the Tattooed Chef management, I'm looking at the value of our shares relative to what I perceive to be the fair value as management, and I will utilize the lowest cost of capital as long if I am willing to do so, right? That's the argument, right? Because management should have a fiduciary responsibility to the shareholders, and in pursuing the longevity of the business should take the lowest cost of capital. So in this instance, if you believe shares are overvalued, you want them to dilute you. If you believe shares are undervalued, you would say dilution is very bad. Okay, very bad, because that, in your opinion, because if your opinion is correct, it's detrimental to the longer term realizable value, because you're splitting up all those future profits, all that future value, with more and more pieces of the pie. Okay, so I want you to keep that in mind. Right now, Tattooed Chef is not profitable on a cash flow basis and on a GAAP net income basis. So what we're going to do is come over here to this little feature right here, and we're going to say yes. We're going to do an unprofitable analysis, right? So when a business is unprofitable, we come over there and we just click the button yes. And then now the model is activated to the point where we can analyze a business from the standpoint of it being unprofitable right now, but we think it will be at some point in the future, at some point in the measurable future. Let me be very clear. So let's first start with a 10% required rate of return. This implies that a no growth at a fair value of $1.5. Okay, so I want to be very clear before we begin on the rest of this stuff. I'm going to change this margin over here, right? And I'm going to change it to 15%. I'm going to be extremely generous. So no one can say that I'm being disingenuous and not giving Tattooed Chef a fair shot. I'm basically implying there that they are going to have stable 15% cash flow margins from whatever time period I designate. And on top of that, we'll get to the stability part in a second, but on top of that, it will be higher than Conagra's. So Conagra's, like I told you, had a maximum point of around 13%. I'm saying no, Tattooed Chef will be better than Conagra and will achieve 15%. So I want you to realize that that is aggressive. Okay. Second, the year of profitability, that's actually kind of grammatically incorrect. I got to correct that, but I'll do it later. So that means what year will they achieve this? Okay. So I'm saying, they'll achieve it in year, let's say 4, but if it's in year 1, that changes the numbers quite a bit, right? Because you see it doubled the value, because remember that when we are looking at cash flows, $1 today is more valuable than $1 tomorrow. So if that is the case, as I bring forward the profitability measure, it does increase the value of these cash flows. Okay, so let's go back to 4 years. I think I'm being very generous, by the way, 4 years. Some people have the analysis that's saying they're going to get profitable, for example, in 6, 7, 8, 9 years. Let me show you what that looks like if I say 8 years. You see, it becomes less valuable. Let's go back to 4 years. You see it? Now, if I press enter, it's back to $2. Okay. And if I go to 1, you can see again, up to $4. Okay. So let's go back to 4. So right now I have a required rate of return of 10%. We know that they've been growing at about, on the highest end before, closer to 50%. So I'll give them the benefit and say 50%. So right here, let's look at what I'm basically saying. I'm basically saying I desire a 10% rate of return for the next 10 years. If I am implying a profitability measure of 15% starting in year 4, right? The more precise way to do it would be to actually work it up. And then that's part of the later stuff I'm going to show eventually. But we're just basically saying at year 4, they're going to start rolling in the cash, right? So I'm being very generous. And actually the point of this video is to be very generous, so no one can say I'm being disingenuous and not giving Tattooed Chef a fair shot. Okay, I'm giving them a very fair shot to see whether or not I'd buy them. Analysts have this, by the way, at a buy rating, implying a 12.98. And well, that implies a 6% upside from here. Okay. So let's actually take a look. That IPO date, by the way, is incorrect. That's the SPAC. So you can see the management team right here, and the compensation, the currency pay, and their birthday, and their gender or whatever. All right. So I put it there just in case anyone wanted to pause there and take a look. All right. So going back to this, right, we can see, well, we got to actually fill in these growth rates, right? So let's actually say, okay, that's 45%. And then this is going to be 40. And then let's decay it a bit to about 30%. And then let's go 20%. Okay, so 20% on the low end. I think I'm being very fair with these growth rates. Will it achieve these growth rates is the question, because 50% every year is a lot of growth. Okay, so I don't know if they're going to be able to achieve that, but I'm just putting it in there. All right, but this is, again, no dilution whatsoever. So they're not going to issue a single more share. And I'm only asking for a required rate of return of about 10%. All right. So on that note, let's actually see what happens if I ask for a little bit of a margin of safety. Already there, I can't achieve a greater, or I'd have to assume greater than a 20% for sure. Let's be a little bit more precise. Let's see if 25% does the trick. So 25% still does the trick. Oh, also one thing to mention, you guys can look at the portfolio recommended weighting by the model. And essentially, if we're telling the model that we think all the scenarios are probable, just we don't know which one is more probable than the other. Of course, I could adjust those metrics, but I'm just leaving it all the same, weighted the same. And you'll see that it starts to adjust depending on everything else, right? Depending on all these other factors, right? According to the bankruptcy analysis, we have the Altman Z-score that says no, and the model's own metric that says no. So for the time being, this appears to be a safe business regarding the financial statements or the balance sheet. That may change at any time in the future. Okay, so also I'm going to refrain from looking at the ratios. There just simply isn't enough data currently. So again, because of that, that's why I said that phrase that could change in the future regarding the bankruptcy analysis, because I also want to be very careful with what I say regarding that, because again, because this business is so new, so many things can change. We already had them, not report at the right time twice. I'll say this one comment. What they're doing right there is not so difficult that they actually should delay. Something weird is going on there. I don't know what it is, so I won't actually claim to know exactly what it is. All I will say is that it is a little bit concerning, and that's about it. All right. So, but going back to the model, we already are understanding that again at 15% required rate of return, we start to have to assume some growth metrics. I want to be very clear before I continue is, again, a reminder, I'm being very aggressive with this 15% over here. I am also not assuming dilution, which is actually a very probable thing. And again, you need to go back and keep thinking as we're going through this. Should I and would I be diluting the shareholders? Because again, you come to that question, are the shares overvalued right now? Okay, if they are, you want dilution. If they're not, they shouldn't. You don't want them to be diluting you. In fact, you would disagree with management on that issue, right? Because if it is undervalued and they are issuing shares, that is more expensive. Okay, that's even more expensive. Okay, so let's just say, I mean, if we want to assume, well, we'll assume some dilution actually later, right? I want to actually show you guys this though. If we say they get cash flow margins of 10%, which is slightly lower than Conagra, and then maybe after the fact, they will achieve a 10% cash flow margin later down the line, like maybe 20 years from now, when they have even more efficiencies. Well, you see how that kind of changes the metrics quite a bit. So we have to start assuming, I think, close to like 35%. Let me make sure. And again, I am assuming 0 share dilution. 35%. All right, so let's see 33%. 33% is basically where we're at. So 33% and greater. So this is already kind of where they're at right now. Are they going to be able to sustain this every single year for the next 10 years? That's an interesting question. I don't have the answer to that. I want you guys to think about that, right? So let's assume what happens if they become cash flow positive in 2 years from now? Well, now you see it changes the cash flows a bit, but not too much, right? So the extra 2 years, we see that we have a buy price of about 13.47. Okay, let's actually start to assume a greater margin of safety. So at a 20% margin of safety, we already see that the buy price comes down quite a bit if we assume like lower growth rates, those peasant growth rates of 25 that only the value stocks do, because 25 is easy to do. That implies a value of about $4.70. Okay, and again, let me go back and be fair and keep it to the 15%, right? Just to keep consistency. Well, the buy price is about $7 a share. Okay, so right here we're at 20%. Now let's go to the big mama jamma. So let's go to 27.1. And for anyone not know why I chose it, is 27.1% compounded over 10 years is a 10x. Okay, so that's right here. Implied return is 1,000%. That's a 10x of your money. Okay, so let me actually real quick just do this. All right, yeah, I'm back. The camera was just not focusing. All right, so taking a look at the current assumptions, now we have to assume even greater, right? Basically a 45% or more. 45% is insane. 45% growth every year for 10 years. Wow, this is a tech company at that point. If we go back, and this is why I'm echoing that, if we go back, actually, this is actually assuming they achieve Conagra size, right? Some of you, and I don't want to dismiss it entirely, some of you might say, well, that's possible, right? Because look, the frozen food category, if they were to achieve Conagra size, that would be an implied growth of 42%. Let's go back to the model. We're assuming 45%. So not too far away from that. Can they achieve that? Maybe. That would be a 10x right there. And then again, let's actually bring this back down to 4 years. Okay, so if it's in 4 years profitability, we're not so much, but we're not too far away. Okay, so I'll give it that. We're very close to that being a reality. Okay, and let's get that 42%, right? Okay, so at 42%, okay, we do have to actually that's marginally less. Okay, so from $12 to $9. Okay, and then before, let me see what it was. Yeah, 1160. Okay, so at 42%, this again implies that growth going somewhere in line with Conagra. So let's see what happens now if I start introducing the share dilution. So first, I'm going to begin with a negative 2%. All right, so a negative 2%, how that affects me, we can see how the prices have come down quite a bit. Now the 42%, even with the 15%, is now at a $7.94. So let me take that away for a second. Let me say 0%. We go back to 968, and then we say negative 2%, 798, 94. And I'm looking at the 42%. All right, so, and then let's see, okay, how does the 2% affect the 20%? Well, we can see now things have again come down a bit in terms of value, which means we have to, get a higher or lower price in order to achieve our goals. Easier said than done. And I'm looking, for example, now let's drop it down to like about a 5%. So at about a 5%, now things start to get, a little bit crazier, because now we can't even assume a 20% required rate of return. So we're pretty far off now the 10x, right? The 10x that some creators have espoused, and we've talked about it in the past. Some creators, again, that's where it's coming from. We're basically saying, they're saying that it could 10x, in 10 years. And these are the assumptions I have to make. By the way, 42% is a lot of growth. And also, by the way, 15% cash flow margin is higher than the current leader in comparison. Okay, we are assuming they are going to achieve higher efficiencies than the leader in just 4 years, and they're going to grow at 42% compounded for every year, and then the buy price is 1173. I want you guys to appreciate how aggressive that assumption is, right? And so with that, you kind of can guess my thoughts. The assumptions I have to make for this business are quite aggressive. Here are some key risks that I want to highlight to you guys, and they're no different from what I was discussing earlier in the previous video. So they mainly have to do with the inflation fear. So should inflation continue at a not sustainable, but at a frequent rate, right? As it's been doing thus far, right? And when I say frequent, I mean elevated. Sorry, that's the more proper word, elevated rate. Then and I'm talking about the producer price index, right? So the cost of producers, right? Because I don't really care about the consumers. For what I see, they haven't been raising the prices too much. And they've talked about it a little bit. They think, and I think they hope, that inflation is temporary, right? And so for their sake, they have to hope that, and that's a separate argument or a separate video entirely. So I won't even get into that, because they may be right or wrong. But regarding the actual business, the business will need inflation to normalize, or for them to gain pricing power. And then that segues into this segment, right? So this segment, the frozen food category in particular, doesn't have much pricing power. It is a very, very, very competitive business. If you go to the frozen food aisle, you will see a plethora of options for consumers to choose from, right? You have many, 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 many different brands, and consumers in this category price sensitive. I think people are kind of kidding themselves, and actually makes it a little bit worse. This is not catered towards the affluent community, right? I think people who believe that need to rethink that. So in the affluent community, do we really think that they're going to eat microwavable food? Probably not, right? And if we look at kind of this is the second mental exercise that we're going to do together. And you can comment down below your opinions and what you think, right? What do you think, or who do you think is the target consumer of frozen foods? I'm thinking, when I think about it, it's probably the worker who goes to the office, right? Of varying income capacities, and they don't want to eat out, for example, right? We have a comparison. Let's say you have Chipotle Mexican Grill, a bowl for about $8 to $10 to $12, depending on what you get in it, and depending on where you live. And you have, a Tattooed Chef bowl. Let's say it's $5, right? So it is cheaper, right? Of course, albeit it's less filling, less calories. I think it's objectively so than a filled up Chipotle bowl. And maybe the sodium content is a little bit more in the Chipotle bowl, but the sodium content in the Tattooed Chef bowl isn't too much far off, right? And again, there's reasons for that. It's a frozen food and all that. But anyways, regardless, the optionality that the consumer has is like, okay, which one do I go for? Well, if I go for the Chipotle bowl, I'll pay up a little bit, right? If I go for this one, I can just stay at the office and I just put it in the microwave and I can get back to work, right? And I can save some money, right? You won't eat as much, and maybe that's a good thing. Maybe that's the goal of the employee. But what I'm seeing, or what my mental exercise is taking me, and I could be wrong, I do think it would be interesting to find out how the work from home trend has potentially harmed Tattooed Chef, because I think their type of food is good for a office environment, right? Where I go to the microwave and I, put the food in there, right? Well, and it's give or take, because someone might say, well, when we go back to the office, there's going to be more of that eating out, you go after work and eat with your friends, blah, 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 blah. That could be true too. So it's a give or take in that reality, right? So those are some things I want to think about. But going back to the crux of the problem, the consumers in this frozen food category are more price sensitive than the average, right? And we go to snack food. Snack foods is higher margin and also more pricing power in that category. Pepsi dominates this, right? So Pepsi has a plethora of snack brands. We also have Mondelez. Mondelez is a giant. Oh my gosh, I actually love Mondelez. They own Oreo, by the way. So the Mondelez brands are very powerful. We also have, Campbell Soup. We have all these companies. Of course, Tattooed Chef is trying to come in here and say, well, we're going to be the healthy option. Well, these other companies, they do have healthy options too, quote unquote healthy options, right? We can have a debate about that. But the point is, Tattooed Chef's going to try to come in here and market themselves as the healthiest option, right? Or at least market themselves that way. And if they succeed in this capacity, well, they're going to have a bit of pricing power. Yes, if the branding is it's quite a bit more important in this category